We're analyzing Elevance Health, stock ticker ELV, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Elevance. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Elevance Health for your portfolio. Before we get into these valuable metrics, let's understand Elevance Health's stock performance. Right now, Elevance Health trades for $482.58 per share. In the last year, their stock price is down 7.5%. The company pays a 1.16% dividend yield, so returns to shareholders are a little above this. In the last 5 years, Elevance Health is compounding at 15% annually. In the last decade, they're compounding at 19.5% annually. This is far outpacing the S&P 500 during this time. Going back prior to the global financial crisis, in the last 18 years, Elevance Health is compounding its stock price at about 12% annually. Their average dividend yield throughout this time is in addition to their returns in their stock. Elevance trades $42 above their 52-week low. The company's down about $60 from their 52-week high. Under 1% of their shares are sold short. Elevance Health is a very big business. They have a $108 billion market cap. But the burning question is, why should we be paying close attention to Elevance? Elevance Health, formerly known as Anthem, remains one of the leading healthcare insurers in the United States, providing medical benefits to 48 million members as of December 2022. The company offers employer, individual, and government-sponsored coverage plans. Elevance differs from its peers in its unique position as the largest single provider of Blue Cross Blue Shield branded coverage, operating as the licensee for the Blue Cross Blue Shield Association in 14 states. Through acquisitions such as the AmeriGroup deal in 2012 and MMM in 2021, Elevance's reach expands beyond those states through government-sponsored programs such as Medicaid and Medicare Advantage plans as well. Starting with metric number 1, we want their average 5-year return on capital to be above 14%. The average publicly listed business earns about a 7% return on capital. Over the long run, over the course of decades, a stock's likely to return approximately what its underlying business returns. These business returns are captured by return on capital. We can build in margin of safety based off the overall quality of the business being about twice as good as average. Elevance has slightly increased their returns on capital throughout this time. Their returns have been in the low to mid-teens in all 5 of these years. Averaged out, Elevance earns 13.3% average returns on capital in a given year. This is less than a percentage point below the benchmark we'd be looking for. While it's well above an average business, this is still an X for metric number 1 on Elevance. Metric number 2, we're looking at the company's growth from a high level. We want to see revenue, net income, and free cash flow growth in the last 5 years. We'll be including their last 12 months worth of numbers. This metric's all or nothing. All 3 have to be up for this to be a check. During this time, Elevance has grown their revenues by 74%, their earnings are up by 66%, and most notably of all, their free cash flows have more than quadrupled. This was due to having depressed free cash flows in 2018, but as the company has grown and they've added on through acquisitions, they've significantly increased their cash flows in their last 12 months. This is a big check on metric number 2. It's great to see their free cash flows lead the charge because free cash flow is the lifeblood of any business. A business's abilities to produce free cash flows now and until judgment day, discounted back by some reasonable interest rate, is what that business will be worth. We'll be using that exact method later in our video to come to an estimate of a fair value for Elevance, so stay tuned. Metric number 3, we're taking the perspective of an individual shareholder by looking for earnings per share growth in the last 5 years. As we just learned, their earnings have grown by 2/3 during this time, and Elevance has bought back 8.5% of their shares outstanding. These 2 factors lead to very strong earnings per share growth. This is another check on metric number 3. Metric number 4 is similar. We're looking for free cash flow per share growth in the last 5 years for Elevance. With their free cash flows more than quadrupling in their share buybacks, this is a big check on metric number 4. Recapping where we stand currently, through our first 4 metrics, we have 3 checks and only 1 X for Elevance. During economic downturns, it's overly levered businesses that are at the greatest risks of poor outcomes. In metric number 5, we want Elevance's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow the company has produced in their last 5 years. Elevance ended 2022 with $17.7 billion in net debt. They've reduced this so far in 2023. Right now, they have $16.2 billion worth of net debt. In their last 5 fiscal years, the company has produced $31.8 billion worth of free cash cash flow, and in their last 12 months, they produced about $11 billion worth of free cash flow. Both of these numbers easily and comfortably support their net debt position. This is a big check on metric number 5. Relative to the debt that Elevance is using in their business, it looks like they're strongly cash flow generative. Before looking at a valuation for Elevance, it's time for our bonus. As our bonus, we're looking at Elevance's dividend profile. Right now, Elevance pays that 1.16% dividend yield. As they're returning this capital to shareholders, we want this to be supported by the company's free cash flows. That's been the case in all 5 of these years. Elevance has not only grown their free cash flows, they've also grown their dividend payouts. They've maintained a very healthy and very low dividend payout ratio. While this is a snapshot of their last 5 years of performance and it's no guarantee for the future, Elevance's dividends look like they're in good shape as they've been very well supported, and they've grown by quite a bit in the last 5 years alone. The big metric of them all, metric number 6, we want Elevance's average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this offers a reasonable starting point for a valuation of Elevance and could tell us if the company looks cheap. Right now, Elevance has a $125 billion total enterprise value. This number takes into account both their market cap and their net debt position. In their last 5 fiscal years, Elevance produced $31.8 billion in free cash flow. In an average year, they produce about $6.36 billion worth of free cash flow. When that's divided by their $125 billion total enterprise value, we get about a 5.2% average free cash flow to enterprise value yield. On a current basis for the company, Elevance produced about $11 billion worth of free cash flow in their last 12 months. When that's divided by their enterprise value, that gives us about a 9% current free cash flow to enterprise value yield. Both of these are coming in above the yield of the 10-year treasury, meaning this is a check on metric number 5. But hold your horses, don't just run out and go buy the business. There's still more work to do. We want to come to a more concrete estimate for a fair value of Elevance. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Elevance Health, which takes us on to using a discounted cash flow model to come to an estimate of a fair stock price for Elevance Health. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Elevance has been a highly predictable company in its past, but that's not a guarantee for the future. We're starting with a 3-year average of Elevance's free cash flows, then using historical assumptions to grow these into the future. It's up to you to do your own homework to figure out if these assumptions are accurate going forward for the business or not. Assuming they grow their 3-year cash flows at a rate of 9.9% for the next decade, then assuming that this growth is cut in half for the decade from there, if we add in the company's tangible book value, which gives us an estimate of their net worth, if we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for in addition to his margin of safety requirements, at today's current valuations, it looks like an estimate of a fair stock price for Elevance Health is around $386 per share. That's down $70 from the company's current stock price and also down $56 from the company's 52-week lows. Right now, it doesn't look like there's a margin of safety in the business using these assumptions. There are some key points to be mindful of. Elevance has been a very predictable business in its past. That's not a guarantee for the future. This 15% discount rate estimates total returns to shareholders. It would already be including their dividend yield. Also, the company's net worth could be higher, as how the accounting is done for share buybacks skews this potentially lower for businesses. So it's worth looking at the company's balance sheet as well. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before considering any investment decision. In just a minute, we'll give our final rating to Elevance. But we have to address something first. We focused a lot on the quantitative by covering the numbers. But what are the qualitative aspects of this business? Starting with the qualitative factors supporting a potential long thesis. Number 1, management aims for relatively high core earnings growth of 12 to 15% over the long run. Number 2, the company's Carelon service platform, which includes its PBM, should support material savings for clients, higher profitability for Elevance, and the potential to boost growth with cross-selling opportunities. Number 3, Elevance continues to use its scale-related advantages for the benefit of clients, and its ongoing efforts to align incentives with caregivers are intriguing, including the development of high-performance provider networks. Then the qualitative factors supporting a potential short thesis. Number 1, the bulk of insurance membership growth in the long run may stem from lower margin government-sponsored plans, creating a structural headwind to insurer profitability. Number 2, headwinds like Medicare redeterminations and potentially less attractive Medicare Advantage dynamics may decelerate the industry's growth trajectory starting in late 2023. Number 3, the insurance and PBM industries will likely remain targets of regulators aiming to reduce the healthcare cost burden on society. This could be a key risk. There you have it for a balanced perspective of some of the qualitative aspects of Elevance. Now it's time to give our final rating. In analyzing Elevance Health, stock ticker ELV, the company performed very well on our Select 6 analysis. They were just slightly off when it came to their returns on capital. Those were well above an average business. The company is regulated, and those were still at a high level for regulated returns. That's something to be mindful of. Elevance looks like a strong growing business that's not overly levered and trades for a reasonable valuation right now. It's also been returning capital to shareholders through its share buybacks and through supporting a growing and healthy dividend that's easily covered by their free cash flows. It's worth reiterating this analysis is not financial advice. When we performed our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions from today's valuation, if you're seeking a 15% rate of return, an estimate of a fair stock price for Elevance is around $386 per share. The company was last at those levels in October of 2021. When we combine the factors of our analysis, Elevance looks like a very strong candidate for further research. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, comment down below what business you want me to look at next time. Thanks for learning about Elevance with me, and have a great day.